All right, so we're looking at the report for the end of December 15th, 2012. Bullish normal, neutral on both short and long term. Percent stretch compared to the 200-day moving average, we're only 0.82% away from sideways. Slope of the 50-day moving average is neutral at yellow neutral at minus 0.12. ADX extremely weak and choppy, the sideways chop, untrending market. ATR percentage is still low. It's below 1% now. No change in the monthly rebalancing. They're looking pretty good with that focus on the global ETFs. Next reevaluation on or about 1 January. So trade of the week is one of the links I was referring to. If you just go to the YouTube channel, you'll see it. It looks at about 5 or 6 different trades from this week. The blended monthly rebalancing portfolios, mostly going to buy positions. Everything global is working right now. The notable exceptions are U.S. real estate and technology are weak, and then these the commodities and U.S. technology and real estate are weak in the 26 ETF. So that's a complete reversal where the market was 6 months ago. So sector cycling does present itself as an option. Market health checks, some things to highlight. Blue vertical lines, 10, 20, and 30 days worth of look back. Horizontal lines are resistance levels that we're using as price targets. We're at this one here at 143, and the next one's at 147. We've had a pretty nice little bull run here over the last 30 trading days, but it's got to get above 147. Otherwise, it's still inside this trading channel that is going between 147 and 135. So it's about 9% trading range. I've added the lighter shaded blue around the river. I'm thinking of that now as sort of the floodplain, and that is 30-period Bollinger Band, and now that's plus or minus 2 standard deviations, and that's by definition always going to show the boundaries of an extreme move. And you can see how this last one moved from minus 2 standard deviations when it dipped below the 200-period moving average into the red, and then has made this nice move up here to plus 2 standard deviations around 145. So that's that's a 4 standard deviation move. That's a heck of an intermediate leg. It's really the same thing that we saw on the way down. Last time it failed at 147. So that establishes this sort of a V bottom. And now there's reason to believe this would be a natural place for price to hesitate. Why? Because it did before. The last time it got to 143, a sharp sell to 135. That's about a 5 or 6% move. So we're 2 days into that in the U.S. after a nice move. It's right at the boundary of the river. The 10 is rolling over. The 10-period moving average is rolling over. The regression is very wide. The 200-period moving average is catching up to this river. You can have really been able to pull away. So this is really Fisher cut bait time. Is this leg one of a grinding bullish move up? If so, it's got to get through 147 to be actually a second leg. Otherwise, if it fails here, it'll come down to 139 and 138 here at the 200-day moving average, and then the next support would be at 135. So that's what we're looking at. So what that tells me right now is that we have a market that is still well suited for intermediate tactical trading, that is direction neutral, that's looking to reward short-term momentum and then cash in when you got them. You see that reinforced here with the PPO, the percent price oscillator, which picked the start point here around November 19th pretty well. And now those jaws of PPO are just about closed 20 days later, and you can see how PPO is actually a pretty darn good descriptor of the trends. You can see the 2 legs down that started back at the end of September when PPO crossed one here to November 5th, and the second leg down here. So PPO with these settings here of 10, 20, and 8, I think does a pretty good job of keeping us in tune with the life cycle of those intermediate trends. So conclusion, trader market, it's already extended to the on the buy side. It's up into places. It's into a place where you expect to see some failure. Now the U.S. markets have given back these last 2 or 3 days. The globals, on the other hand, we'll see when we get to the chart deck, really didn't do that. So there's weakness already forming inside the U.S. So let's go ahead and move on. Let's see. All right, so what I'm showing on this one is essentially the same time frame, but I've been exploring the use of, let's see, let me get this larger on your screen, of stock charts, and I'm pretty happy with how the charts that it produces. Let me size that up for you a little bit. All right, so this is the same 4-month look-back period, and you can see the river plus or minus 1, the floodplain, the sandy floodplain here, plus or minus 2. Bollinger Band mean is this red line that runs through the middle of the river. Because of the black background, we've got the 30-period regression line is the thick white line, and then the 10-period is this light-colored blue line. And the orange ribbon in the background is the 2-period Bollinger Band. And then this white channel here with the extension, that's the 30-period regression line. The question was, does the Bollinger Band 2 use the EMA? No, it's a simple moving average. And so some things I added to this chart. I like the contour. I like the way it shows in free stock charts. I'm really impressed with how easy and flexible their chart package is. I don't think it has all the power of the free with the filtering and screening and whatnot that stock charts does, but I really like the way that it quickly allows you to configure chart on multiple time frames with tabs. So I think it's worth your attention. So some things I want to show is the first one, every yellow circle is an important road mark, if you will. The first one I looked at here is back in looks like June, around June 16th. We had a regression line crossover of the Bollinger Band mean here, and then this bullish move all the way up here. And the next one, when the 30-period regression line was north of that midpoint of the river, all the way up here, and then it shifted and south of the river during this precipitous sell-off until it gets back here. And it looks to me like that when the regression line crosses the Bollinger Band mean, we can say with some certainty that that previous leg, whatever it was, has changed. What you'll notice is in that strong summer bullish move, I say it was strong in terms of percentages, but it was really pretty choppy if you remember that. But it stayed it stayed out of the river. The 30 period stayed out of the river during that entire trending move. And then once it crossed over during the downward trend, stayed out. And it's just getting ready to leave the river now on the upside. So if we don't see continued weakness, if we just see the S&P pausing and refreshing, then that really is the first indicator we are well postured to go up and test this 147. So that's so the first thing I like to look for is where's the location of the 30-period regression line with respect to the Bollinger Band mean, and then what direction is it pointing to, and where is it with respect to the river, in terms of sort of defining that overall trend, and that really does a nice job of marking off line segments here on the 30. So if you look at the 30 as really the trend, the 30-period regression line gives you some interesting insights. Now all of the other yellow circles are pointing towards or identifying regression line crossovers. So I want you to notice where they are and what they do. The first one down here, regression line crossover the edge of the river. Price comes back and tests, finds support, and then moves out. The next one, this is where the 30 leaves the river, and that's the beginning of trending behavior once more after that sell-off that went below the 30. And now there's a really nice trend that follows that signal. On this regression line crossover, I want you to notice that the ribbon never gets across Bollinger Band 2. And so that's, I would call that an orderly pullback. And then when it leaves the river once more and crosses the 10, the 10 crosses the 30, you get another sharp leg up. So it held support and then takes off. That's a really good entry based on the fact that there was failure to fail below the Bollinger Band mean here. Now, anytime you get these regression line crossovers like this one, after an extended move, and then it crosses outside of the river, we're expecting the price ribbon to come back and test the Bollinger Band mean. Now, I say expecting, but the better way to phrase that is not surprised if that happens. And that's what it's supposed to do. Now, this time it just gets to the edge of the river. The ribbon never leaves the river, and the 10 never leaves the river, and now the 30 re-enters the river, and now it comes down and doesn't just test the 30, the Bollinger Band mean, but penetrates all the way to the downside of the river. So not only is it a lower low on an absolute basis, but on a relative basis compared to where its relationship to the 30-period mean. You can see that it's lower on an absolute and on a relative basis. So you get lower lows, higher lows. Lower lows, lower highs, I should say, and then that's followed shortly thereafter by this by the 30-period regression line. The white line has crossed over the 30 mean, and now when it leaves the river here, you can pile on the short side, and then you get a really nice move down. Now, here is where, in this yellow circle, we see the 30-period came back and tested the edge of the river on this little retracement and then failed again. That's the beginning of, or the continuation of trending behavior as soon as price comes out of the river, and now you've got a really nice short. Lisa asks, why is the 30 leaving the river considered the beginning of trending behavior? That's my working definition of it, only because it seems to be a good one. And the beginning of trending behavior, I'm saying, is when the 10-period and the 30-period regression line and the price ribbon are all outside of the river, all traveling together. So in this case, it was the 30 was the last thing to leave. So it's not because the 30 left, but it's because when you have regression line 10 and regression line 30 and the price ribbon all outside of the river, then I'm defining that as the beginning of trending behavior. It's less choppy. You'll notice on this chart that the moves when all that happens are sharp. So on this one, on the short side, from the highlight here in this yellow circle down to this yellow circle, that is a sharp directional trending move. That happens when the price came back out of the river. It was rejected at the Bollinger Band mean, came back out of the river, and now what you had was price has now rejoined the 10 and the 30 regression lines, and you get a sharp directional move. That's trending behavior. On the upside, the same thing happened back in the beginning of August. You had the 10, the 30, and now the price ribbon have all left the river, and what do you get? A sharp directional trending move. And then price decays, and then as soon as price rejoins all three, boom, you get another sharp trending behavior in the direction where all three are traveling. So that's why I consider, that's why I am defining that as the beginning of trending behavior. It's my own definition, and it's a working definition describing what I see. Okay, so that's everything I wanted to show on that particular chart. In summary, I would just say know where the 30-period regression line is with respect to the river and to the Bollinger Band mean, and watch for those crossovers to see what's going on. And also, I like freestockcharts.com. It looks like a really powerful package. All right, we're still at 80-20 on the world market model and the theoretical model. There's U.S. large caps and tech are both below their 4-month moving average. Everything else is on a buy, so that puts us at 80-20. Globals are better than the U.S. Smalls and tech are lagging in the U.S. Smalls and tech are the two weakest indexes. And European 350 and Asia less Japan are the strongest. So that's a global growth on or global risk on trade. That's available right there. I just said risk on. I will be adding a new indicator in there. Robert sent me some nice background paper from Faber that looks at a comparison of the 10-day and the 30-day VIX moving average as a way to define risk on and risk off. It turns out that when the 10-period moving average of the VIX is above the 30 period, that means volatility is creeping back in short term, and that's a good time to go risk off. It seems to add value to asset allocation systems, and I kind of like that. That's a simple program into Excel, so I'll be looking to add that here in the weeks or days ahead. Okay, next up. The world market model just further confirms what we just said. That is, anything U.S. is below average except for the mid caps. Tech is especially weak. Anything Europe dominates. Asia less Japan, and then selected leaders. The equal leaders in Asia are doing well. Australia, Hong Kong, Singapore, South Korea. Mexico's doing well. Notice over here on the business sectors that every global business sector is better than its U.S. counterpart except for energy, which is about a tie. So it's definitely anything global, and that's robust. Look at the top 30 ETFs from the ETF2 database, filtered by the 100,000 shares a day on average. And you'll notice that it's China, Austria, Mexico, China, Hong Kong, Belgium, Netherlands, Germany, Switzerland in the top 10. The only thing that's not a European symbol in there is the U.S. home construction, but everything else is global and everything Europe. So this Stocks 50, this FEZ, that's one that we added a couple weeks ago in the ETF2 model portfolio. That's a pretty decent one. That's continuing to march up. Okay, I want to leap ahead now to the weekend report. So let me pull that up real quick. So no symbols or no signals, no overreaction or channeling. You can see how the volatility spike has rolled over and is now in the low end of normal. ADX is just very weak right now. It's a non-trending market, part of that oscillation, which again favors the shorter-term trader that can be bidirectional. Treasuries offer a channeling signal. Home Depot, Walmart, and Merck. We'll take a look at those three charts. There's a 5-day down in natural gas, a 551W in ExxonMobil, and then there's plenty of ETF symbols that test out well on the auto framer. Let's get to the tactical summary. Let me let that come up on your screen. There's a handful of dojis in the Dow 30. Home Depot, Walmart, and Merck test out on the for channeling and overreaction. Home Depot is, I think, is very attractive right now. My style of trading. It's a max pain candidate, meaning it's lost on a 10-day basis. It's lost a lot compared to its peers. You know, it's down 4.5% at the same time in the last 10 days. Hewlett Packard's plus 15.7, and Hewlett Packard is a sort of a perfect demonstrator case for that max pain style of trading. For the last 6 months, it's horrible. But it had a gap down sell-off and has done nothing but charge up for the last 10 days. That's 15.7. And that is a perfect illustration of the max pain technique and why I pay attention to it. And so when I come up here now, I look at Home Depot. Home Depot has been extraordinary over 3, 6, and 12 months. It's in the green. It's very strong over those time frames. But on a 10-day basis, it's been hammered. And it closed on Friday with an RSI 2 value of 3, meaning it was like a 2-day washout sale. And right now it's number 1 max pain range compression, and it auto frames at 4.7 to 1. It's the only Dow stock that is better than 2 to 1 on a mechanical frame basis. So we'll take a look at Home Depot. Walmart is pretty similar in that it was max pain. It doesn't test out at over 2, but it's got an RSI 2 value of 7. Disney has an RSI 2 value of 10, has no other redeemed qualities though. So we'll definitely take a look at Home Depot. Next one up is the ETF2 tactical summary. Same lens. So a handful of dojis. You got silver tests out on channeling overreaction. Natural gas is a 5-day down. You can see there's plenty of symbols that test out better than 2 to 1 on the auto framer. RSI2, the natural gas has a 1. Gold has a 9. Consumer staples, XLP, that's an interesting one, has an RSI value of 9. Is a 551W and was a doji. And consumer staples have been one of the few leaders in the U.S. So XLP is one that we'll want to remember to take a look at. Excuse me. So we'll look at silver pretty closely too. It's number 2 max pain range compression, channeling and overreaction, and tests out of 2.5 to 1. So I like that. Looking at the market mosaic next. The 30-day regression line in the northwest corner. You can see that it crossed over it on the bottom southwest corner, crossed over its own 10-period moving average back here early, about 15 or 20 days ago, which suggested that maybe the previous swing low was actually a swing low, and that the trend had changed to the upside. That allowed us to get some early insights into up move, which turned out to be in the northeast corner. This is looking back 6 months using that same lens. A 3 standard deviation move off the bottom, which coincided with a decent move in with respect to the 200-day moving average. So I like those market mosaic as an intermediate term alert. I still like this one a lot, and that is the z-scores of the regression line slopes. So we're comparing the slope to its own statistics and then identifying the z-score plus or minus 1 as the boundary of normal. And the thick black line is the one I draw your attention to. That's the 30-period regression line slope. And you can see that it was down at minus 1.5 z-score down here when it made its swing low, when it penetrated the 200-day moving average, and then turned right after that back into normal It's crossed over the mean, so that's where it went positive. Now it's approaching the top of its channel. Now you've seen it's hard for this thing to get much steeper than that or to even maintain that level of steepness. This is a natural place for the intermediate term to cool off. It's doing it already at the top of the river, and so a retracement here, or at least sideways movement for the next 2 weeks, would not be unusual. That would be absolutely normal behavior. The abnormal move would be to be a continuation. Now, it turns out that abnormal moves, when they occur, can be sharp. Look at the times in the past where it was flirting with the top of the river and made sharp moves. So we got to be prepared for that possibility up to 1.7. But the fact is that it's already made an exceptional move off the bottom, and that's what this regression line indicators tell us. Hey, be quiet over there, girls. The Huskies are singing to me right now. All right, so I want to shift now over to the chart pack. Now these are uploaded in the chat room if you want to pull them down. So we'll just take a look at a handful of these. I'll just look at my old standby first, Alcoa. Okay, let's so Alcoa. Oh, I'm sorry, that's ASP. Sorry. I like this move here in Alcoa. Dogs. The regression line just crossed over its zero line here, and that suggests a potential up move as it just went. The slope just went positive. The 10 period has been acting as a strong support all the way up. Friday was a big closing up day, made a new swing high. It left the river. The river at least is getting flat, and it's getting close to crossing out of its own over its own 200-day moving average. So the 30-period regression line has given us the early warning of a potential up move here. It crossed the Bollinger Band mean way back here, so that's potentially a good one. The last time it did that was back here in middle of October, which alerted us to the possibility of a downside trend, and it did. And so this is warning a potential upside trend. If it does, it can definitely get back up and retest swing highs from September. So Alcoa looks promising. American Express showing price sharply rejecting the top of the 2 standard deviation Bollinger Band after a nice move off the bottom. So that one's looking a little tired. Could be time for finance, which has been doing really well, to start giving back. Boeing, not much. Caterpillar looks very interesting to me. It's been underwater for a long period of time. 6 and 12 months ago, Caterpillar was the sizzle. It was up around 120, and it's got nothing but go sideways and fall back under its own 200. Now the 200 period has moved back. It's found a triple bottom down here around 80 to 83, and has now left the river. The regression line is positive. The 10 is moving out of the river. The river's starting to roll up. It can get above 90 here pretty easily, but it's really got to get through 93. But this looks very promising for Caterpillar. I like it. Cisco looks brilliant in a world in which U.S. tech has been horrible, like Apple's been horrible, and Cisco's brilliant and continues to look good. It's above the previous swing high at 1950, held support, and had 2 positive days on Friday when tech actually sold off. So it gets through 20, and it should really low. You can see the positive strength here of ADX pointing to the upside. That's a very, very favorable chart right there. If people start buying tech because it's been so long, that's going to contribute some index strength to Cisco. So I think long term that one should be on our radar and stay there. Chevron looks very good. The river came down and tested the lava, found support, is now taken off. It's outside of the river. The regression line just went above zero. Looks positive. Energy could be on its way back. DuPont is, on the other hand, is at the bottom of its, the first half of the cup. The nice thing, it's made a double bottom with a higher low. We got something like a sideways quiet channel working here, and I like DuPont above 45 because now it's got a 10% move just to get back to the 200 period moving average. That looks like a very favorable signal, and then I like the fact that the regression line just crossed over the zero line, so the 30 period regression line just tipped positive. It doesn't take much to get it through sell-off over here at 46, so I like DuPont right there. Great American company. Disney looks like the S&P, nothing much to speak of. General Electric showing some resilience here, stronger than the market has been. Only barely dipped under the 200. Regression line came back to the river and has left the river. Didn't sell off much here. That looks very favorable in General Electric. Okay, here's what I like about Home Depot right now. So it was a 2-day washout there, which gave it that low RSI2. It's just come back now to the 50 period moving average, which is the thick blue line. It's at the bottom end of the river, at a place where it's found support before. It's oversold, so it's both an overreaction and a channeling signal. If it holds support here at 62, I think it's back up through 65, and then all the way to 70 because it took out the previous swing high on that surge up. So this looks good. Home Depot's one that we want to keep on our radar. This is what the max pain range compression looks like in Hewlett-Packard. I've been trading it on a tactical basis intraday. Maybe I should have kept the swing position on. But that's what max pain range compression looks like. Sold off sharply into a doji and then has done nothing but return 6% in the last 10 days. But now it's at the top of the floodplain. It has cleared this resistance at 14.5 though, and so the next step up is 17. I think we can keep playing that thing tactically. You may want to take a flyer on this one as a rebound story, or you might consider it anyway. For me, it's still a tactical trade. I like IBM as a tech play here too. It's shown some orderly, a triple bottom, almost an inverse head and shoulders, finding support at the Bollinger Band mean like it's supposed to. It's 194 out above the 200, and then that will bode well for it because it will have cleared this resistance from November and October. 30-period regression line just went positive. PPO oscillators pointing up. I like IBM as a stealth trade here. Intel, it's earlier in that same story, and so it's got further to go. But you can see how IBM continued to, and Hewlett-Packard started to march along. Here's a case where Intel is earlier in the life cycle of that story. It still has more work to do, but if it does, you get paid more by getting that earlier position in. It made a swing low around 19.5, a higher low, held support, crossed the river, and the regression line is showing an improvement in strength. So IBM is tradable. Johnson & Johnson, the chart speaks for itself. 200-period moving average is nowhere in sight. It bounced off the bottom of the river. The regression line is positive. It went to an extreme move up, pulled back, found support at the edge of the river on the north shore, and getting ready for the next leg up. Johnson & Johnson looks good, and consumer staples. JP Morgan, unqualified success here. Gets above 43 and off it'll go. It's well above the 200, never even got in there. The regression line is positive. All systems go on finance. I like Coca-Cola here. Has found and maintained support above its 200 period moving average. Regression line is positive. Just tested the swing high at 38 once more and was positive Friday. Gets above 38 and it's off to the races. Now we'll fast forward over to Microsoft. This is what failure in tech looks like. This is much earlier than IBM. If Cisco was well ahead of the tech curve and IBM was a close second and then Intel was in third, Microsoft is a distant last. It's made it on the recent swing low. It was a lower low. It didn't make a new high on this little bump here to the Bollinger Band mean. So it has to prove itself. It's much earlier in the case for the recovery of tech. And so it's got to hold here above 26.5. Then it's got to clear 28 to get to the top of the river. So a lot of work ahead for Microsoft. Not very promising. There's other leaders in tech that you'd want to look at sooner. Pfizer looks excellent. V bottom, found support where it held support last time at 25.5. As long as it can hold above the river or the Bollinger Band mean, that's going to continue to be a good trade. Okay, we're going to shift now to some ETFs. Let me come back to Walmart just for a moment. Walmart looks interesting to me. There we go. Hard sell-off from 77 to 68. Made a nice run to the top of the river at 73. Has come back to 69. Has held for the last 3 days above the previous swing low. Held above the 200. This could and had a nice doji the last 2 days. So if it can hold here at 69 for a risk of $1, you can definitely see a retest to 73 in the cards. If it gets above there, it gets to 75 and 78. So Walmart is looking favorable. As long as it's above this 200-day moving average, that'll be a buy on dips. Okay, so now we'll take a look at some ETFs. DBA is just suffering. The only nice thing is it's holding right here at the 200 period moving average with a higher low, and there's room for it to go. The regression line is showing the indecision here. It has to make its move now. Otherwise, it's going to be a depressing downward slide for the X. DIA in better shape than SPY. It's still outside the river. Has made a nice move off the bottom, as some of those conservative large caps in healthcare and finance have been carrying the day. Contrast that with EEM, emerging markets, and it just doesn't any better than that. And +1 to the ETF2 system, which gets into emerging markets, Asia, less Japan, China, all that stuff earlier, a couple weeks ago. So the relative strengths help us there. They've cleared 42, held support. Friday was an update. If it gets above 43.5, there's no resistance overhead, and off it goes. You'll see that that's a theme that's reflected in the other globals that we'll see. EFA, same condition. Asia less Japan, same thing, EPP. Anything global is working. Even Japan is above its 200 period moving average. Brazil coming up to its 200, and when Brazil is starting to look not so bad, maybe this is the real deal here in emerging markets. The 30-period regression line is at the 0-1. If this is really a good global move, then Brazil's going to get above its 200 and go, and then start playing catch up. Gold is reflecting, I think, the fact that money is cycling over to equities, a little strong case for belief there. But at 164, it's still above its 200-period moving average. I consider it to be like biding its time. If we see weakness in the equities for a couple days, watch for gold to spike. And then 164 will look at entry. Europe is just an awesome chart, high EV. That's an easy play for all those sectors and all the large caps in Europe. You can see here that Latin America, slightly better than Brazil. It's already above its 200 and starting to go. And the last chart I want to look at is IWM, the Russells. You can see this is one where it rejected the floodplain here and has come back into the river going sideways. And so the U.S. is a couple weeks of strength behind Europe and the globals. And so right now, momentum in Europe and the globals is the place to be while they have the leadership. So that's everything I want to cover. That's about 15 minutes. I'll try to process this recording, and hopefully it will it'll upload to YouTube. I could not get last week's redone, so hopefully this one will work a little better. Anyway, I'm going to stop the recording there, and I'll stick around for a few minutes. Good luck, good trading in the week ahead.